You are welcome. When you are trading on the lower time frame without taking into consideration the direction of a higher time frame, it can be very risky. Hence, it is highly recommended that we consider top-down analysis, which is a method of analyzing the chart using multiple time frames, starting from the higher time frame down to the lower time frame. In this part of the video, we are going to be considering several concepts that will lead us to the proper understanding of the top-down analysis, while in part 2 of the video we shall consider the top-down analysis in details. We can make use of 2 time frames, 3 time frames, or even more time frames for a top-down analysis. But as an example, we are making use of 3 time frames: the daily, the 4-hour time frame, and the 1-hour time frame. Apart from the combination above, we can also have other combinations for a top-down analysis, as you can see in the example. The higher time frame is used to determine the direction of the market, whether it is bullish or bearish or in a consolidation. On the higher time frame, you look for the most recent break of structure. If it is bullish, then we may conclude that the higher time frame is in an uptrend. But if it is bearish, we may conclude that the higher time frame is in a downtrend. When the lower time frames line up, in this case the 4-hour and the 1-hour time frames line up with the higher time frame directional bias, we say we have a condition of time frame confluence, and it's a very good condition for high probability trade setups. For instance, if the daily is bullish, we wait to see a bullish break of structure on the 4-hour and also on the 1-hour. If the daily is bearish, we wait to see a bearish break of structure on the 4-hour and on the 1-hour. Price is fractal. Could mean that there are waves within waves, or the higher time frame structure is made up of the lower time frame structure. And we recall the concept of impulsive and corrective waves. The impulsive wave is a wave in the direction of the trend, while the corrective wave is a wave in the opposite direction of the trend. So if the higher time frame is bullish, the impulse leg AB, for instance, of the higher time frame is a nice bullish trend on the lower time frame made of several impulsive and corrective wave pattern. So you can see that this 1, 2, 3 wave is being repeated here severally. So this is what we mean by the fractal nature of the market. In the same vein, the higher time frame correction BC is a nice bearish trend on the lower time frame. So we can actually trade against the higher time frame trend when we are on the lower time frame. But we must keep in mind that we are trading the higher time frame retracement, and so we have to manage our trade properly. Premium discount, Fibonacci levels, and ICT OT zones. We can see that the market is bullish, so we wait for a bullish break of structure, and at once we noticed the beginning of the pullback. We can then label our range high and our range low. We pull out our Fibonacci retracement tool to measure this impulse. After the measurement, our 0.5 or the 50% level being the midpoint of the range is the equilibrium price. Any price above the equilibrium price is premium, and any price below the equilibrium price is discount. And we have the OTE, which stands for optimum trade entry, which is a boundary between the 0.62 and the 0.79. What it actually means is that it's a zone where price will most likely react or reverse from. So we have to keep an eye on that zone, especially when the market is trending. And then, what is the significance of the premium and discounts? Smart money will always want to buy at a cheaper price, that is at discount, and they will always want to sell from a higher price, that is at premium. So knowing this, you can incorporate it into your strategy by saying that you will not want to buy unless price is at discount, and you will not want to sell unless price is at premium. This is a bearish version of what we just explained. We notice a bearish break of structure, and at once we start noticing the pullback. We can then label our trading range A and B. We pull out our Fibonacci tool to measure the impulse. The midpoint between the range, the midpoint of the range is the equilibrium price, and anything above the equilibrium price is a premium, anything below the equilibrium price is a discount. So you can see our OTE zone once again, and you can see our price actually reacted or reversed from that zone to continue the impulsive move. Liquidity in brief. In this part, I would just want to tell us the little I know about liquidity. At first, what we are seeing is the fractal nature of the market in this schematic. We have the higher time frame structure and lower time frame structure. The higher time frame structure can be seen this way: high, impulse, correction, and impulse. So we have the higher time frame structure like this. Okay, and now the basic information I would like us to know is that we have the major highs and lows, which are the higher time frame swing high and lows, and the minor highs and lows, which are the lower time frame swing highs and swing low. The basic information we need to understand is that liquidity rests above hold highs and below hold lows, whether they are minor or major highs and lows. Okay, so That's why you see this sign, this symbol for liquidity above the highs and the lows, and below the lows. And you can also see liquidity resting, though not shown on all of them, but you can as well see that. Now let's concentrate on this area. We notice that we have a bullish break of structure here, and we expect price to return to discounts. And if we expect price to return to discounts, you can actually guess that the liquidity below these lows will be cleared. Okay, the liquidity below these lows will be cleared as the price is retracing. So you be very careful in buying from this zone. Okay, then this zone, because it is in the discount zone, and we actually have an order block that led to the break of the structure, we might look for confirmation entry at this block, and if eventually it goes in our favor, we may target this liquidity above the major highs, which can also be referred to as the external liquidity, because if the uptrend is to continue, then we expect these highs to be broken. Okay, this is the range high, the range low. Once we have the pullback, we have our range high and range low. Okay, and again we have this concept of liquidity engineering. When we see equal lows, in this case liquidity is resting below these equal lows, and then we may expect the liquidity to be cleared. We expect a move to grab liquidity, and it's kind of giving this order block more validity, more reason for price to tap on the order block and reverse. Okay, that is just by the way. Institutional order flow in brief. I will also say something, the little I know about institutional order flow. Now, the first point I would like to make is this: price actually trends, the market trends because they are seeking for liquidity. So if we have liquidity pool above, this market can continue to trend up until the liquidity pool is cleared. Okay, so until the price gets to this liquidity pool, this uptrend will continue. And as we know, in an uptrend, price is making higher highs and higher lows. But in the case of the institutional view, in an uptrend, we say that the liquidity above the highs are constantly being cleared in form of break of structure. Okay, the liquidity above the highs are constantly being cleared in form of break of structure, while we expect the liquidity below the lows to be protected in the case of an uptrend. But sometimes, even though we are still in an uptrend, the liquidity below the lows can be cleared, but in this case in the form of manipulation. Okay, so it is not all the time that the liquidity below the lows are cleared that we expect a reversal. It could as well be a manipulation, and that manipulation is confirmed by the break of the structure in continuation of the uptrend. So I'm just using the uptrend example. You can also try to mirror it with the downtrend scenario. Now let's assume in this case, the reversal case, price has actually got into the liquidity pool, the target is met, and then the liquidity below the lows are now cleared in form of break of structure, different from when we have a stop hunt. SH represents stop hunt. So it's now cleared in the form of break of structure. How do we quickly differentiate it? For break of structure, you may have 3 to 4, 2 to 3 to 4 or more candles, below this low. While in this case, you may just have even the wick, and then back, or one candle and another candle back into the range. That tells us that it is what? A manipulation. So finally, if we have another break of structure here, it's now confirming that price is actually shifting from an uptrend to a downtrend. Why? Because again, the liquidity that it seeks has been met and cleared. So price will have reasons to actually move down in search of the sell side liquidity. Liquidity above the highs can be referred to as the buy side liquidity, and the ones below the low can be referred to as the sell side liquidity. Liquidity at major highs stroke lows and minor highs stroke lows. So we have a break of structure here, and we start noticing the pullback. We can now call this our trading range, like we explained initially. External liquidity exists above the range. External liquidity exists above the range, while internal liquidity exists within the range. So liquidity exists at the high and the low of a range, and if a particular trend is to continue, price seeks to clear the liquidity within the range and ultimately at the range high or low when it is creating the impulsive move. So when price is creating this impulsive move, we hope we are kind of a little bit hopeful that the external liquidity here will be cleared. And so if you enter your trade here, you can, with a good level of confidence, use this as your target, because if the downtrend is to continue, this level would be traded through. Okay, liquidity also exists within the range, and if a particular trend is to continue, price seeks to clear the liquidity within the range when it is correcting. It may clear the liquidity above or below the range during manipulation or change of structure. Okay, you can see this is a corrective move because this is a downtrend. Any move up is correction. It's a corrective move. You can see that the internal liquidity are being cleared, except for this case where we couldn't clear the liquidity and price reversed from there. So this explains why sometimes some other block will not hold, because in this case price is seeking the premium price, okay, and so the other block here failed to hold, because if you look, it is actually below the equilibrium price. So one of the reasons why sometimes our other block may not hold is because they are not, at the premium level or at the discount level. So like we said initially, you can incorporate that into your strategy, even though we have okay, what's this? It's actually impulsing, and we can also actually see that when price is impulsing, the liquidity, internal liquidity, will also be cleared. So you take note of those things. And we have a minor break of structure here. Okay, so the point there is when price is making a correction, you may not expect other blocks in this position to hold. It doesn't mean that they cannot hold. Sometimes they hold, but then your strategy is your strategy. Price cycle and other blocks at a glance. I'll just be very quick with this. The simple price cycle we're going to be looking at is consolidation, which means that the price is in equilibrium between the buyers and the sellers. Then after consolidation, what we normally hope to see is expansion, and during that expansion we can try to locate any other block, imbalance, and so on and so forth. Then after the expansion, we have retracement. This retracement is looking to fill the imbalance, to clear the liquidity, etc. Okay, then after we have a reversal looking to clear liquidity below in this case. Now this is the consolidation, we have the expansion, we identify an order block there, then most likely we have an imbalance here, and we also have a liquidity engineering here that will give us more confidence that the price may be returning to the order block. Then we have the retracement looking to fill whatever imbalance or clear whatever liquidity that we have here. Then we have the reversal looking to clear this liquidity below in this case. Other blocks at a glance. And quickly we would like to look at this sample of order block. We see we have price was creating equal lows here. Under the equal lows we have liquidity pool, and we have this move that came down to grab liquidity and break structure to the upside, and we have this mitigation and continuation. So you can see maybe the other block here might have been responsible for the break of the structure upward. So the pattern we have here is firstly the stop hunt, the break of structure, and the mitigation of the other block for continuation. That's exactly what we have here. We have this candle actually trading below this low, 1, 2, 3 low, and then closing above these two lows. This is a good example of a stop hunt. Then after the stop hunt, we have a break of structure. We also have an imbalance created here. Then the next thing is to wait for price to mitigate the other block so formed for continuation to the upside. So we have this break of structure, we have the mitigation, and we have the continuation. Now you can see another example. In this case, we have the order block here, the last buy to sell candle, breaking structure, breaking structure, creating an imbalance, insufficient price action, IPA, insufficient price action, and we also have liquidity engineering. It's like you set your limits and price tends to be coming close to your order block and then eventually fail to get to it. Just know that it's a kind of liquidity engineering as well. In this case, it is equal highs. and you can see that price actually grabbed the liquidity, and in the process of grabbing the liquidity, tap on the order block, and we have a good opportunity to trade. So these are just order block. Some of the things that gives the order block more validity when you have imbalance or insufficient price action or fair value gap just before the order block. Then again, you have liquidity engineering. You can also see liquidity engineering here, but the liquidity engineering that is close to the order block have things like equal highs, equal lows. You can be rest assured that price we tend to travel up there to grab the liquidity and continue to move downwards. You can also see another order block here, last buy candle before the sell, break of structure. We have liquidity engineering here, and price tapped on the order block, and we have a very good market opportunity for sell. Another form of order block that we're going to be looking at is the stop hunt plus break of structure plus mitigation. Okay, I think it's the same thing this is just the bearish version. So we have this stop hunt, price traded above these 1, 2, 3, 4 highs, and eventually the price closed below the highs, traded above the range and closed. Look at this what we call shooting star or bearish pin bar, traded above and eventually ended up closing below this high, this high, this high, and this high. So this is a good stop hunt. And not only that, it went further to break structure, okay, and then we wait for the mitigation of the order block so formed, the last buy before the sell move, and we have this very beautiful one. Then quickly, okay, we have an imbalance here too, as you can see. Good. Then we have another form of order block where we have the shift in market structure plus break of structure plus mitigation. Price is making higher highs, higher lows, higher highs, and eventually price was not able to make a higher high and instead made a lower high. We say we have a shift in market structure. On top of that, we have a break of structure here. So we identify the order block that actually led to the break of structure. We wait for the mitigation of the order block and for continuation to the downside. So as you can see, price is making higher high, higher low, higher high, higher low, higher high, higher low, higher high, and eventually it made a lower high. This is a shift in market structure. Then we have a break of structure. We look for the order block. Is the order block the last buy to sell candle with the largest body? Is the order block. Then you can see our price mitigated it and continued to the downside. Thank you for your time. So we hope to have part 2 on the way, where we shall actually deal properly with the top-down analysis. Goodbye.